As many of you know, I came to the conference last year. My expectations were blown away. The speakers and the presentations were great. I'm a big skeptic when it comes to trading seminars and education for sale. I really don't think too many of them are worth it. But this conference that Tim has put together is an exception. I've been looking forward to coming back all year. I was registered to attend, and I was recommending to other traders long before Tim invited me to speak. So I'm honored to be here and be speaking to you today. Before we begin, I want to extend a big thank you to some people who were a tremendous help to me. Zach Shellhaus in the corner, the PowerPoint artist. Mark Patterson, who's not here, and Scott Herman proved to be very valuable consultants. And my wife, Kimberly Shabika, who's sitting towards the back. She made many sacrifices to make this possible. I don't want anyone to get mad at me for missing lunch, so to make sure we finish on time, I want you to hold your questions until after I'm done with the presentation. We have a lot of stuff I want to get through. I'm going to stick around during lunch, and again after the presentation after the conference finishes today, I will stick around until every question is answered. So please feel free to come up to me later, and I'll answer any question you have. Thank you. I have with me 3 of my all-time favorite trading books. The Market Wizards by Jack Schwager. We are going to start off today with some quick trivia. The first person to get the question right gets a copy of the book. The Dow hit a high of 381 in 1929. What was the last year you could have invested in the stock market with the Dow still below the 1929 peak? Just give me a guess. 1954. Who's closest? It's a full 25 years later. Now, the Dow hit 100 in 1906. Did you use Google? The Dow hit 100 in 1906. Investors would have one more chance to invest in the market with the Dow below 100 in 1942, a full 36 years later. So if history is any guide, back up. The Dow's most recent peak in 2007 was 14,100. Now, if history is any guide, that means you'll have one more chance to invest in the market with the Dow below that level sometime around 2037. Charles Dow invented the Dow Jones Industrial Average in 1896. This one for the next copy of the new Market Wizards. How many stocks from the original Dow are still there today?
3.
Do I hear 1? Who said it first? All right, I'll give it to you. You got it. GE is the only stock remaining in the Dow from 1896. Tracking hundreds of stocks like most modern indexes would have been a monumental task before the days of computers and calculators. Interestingly, the Dow is not an index, it's an average. That means it's not market cap weighted, it's simply an average of all the prices. So a $5 move on a $200 stock has the exact same impact on the Dow as a $5 move on a $10 stock. Last question, this one, for the stock market wizards. The stock market closed for 4 days following the terrorist attacks of 9/11. The stock market was also closed for 4 days. Excuse me. That's not the answer, by the way. That's not the answer. Stock market was also closed in 1914 when World War I started. How long was trading suspended at the outbreak of World War I?
2 months. 2 months. 1 week. 6 weeks.
He's closest.
6 weeks.
4 months. We got it. There was so much fear of a financial panic that our government forced trading to be suspended for 4 months in 1914. And now, no prize for this one. Does anybody know what % of new traders fail?
75%. 75%.
Well, there is no exact answer, but I always wondered about this, so I did some digging around. I was surprised. I actually found a number of different sources for that statistic, and here are a few of them. Researchers in Taiwan tracked the performance of traders over 5 years, in perhaps the most comprehensive study ever done on the profitability of traders. They found that out of a typical 6-month period, more than 8 out of 10 day traders lose money. There was a New York Times article that said, regulators who have examined the books of day trading firms say that more than 9 out of 10 traders wind up losing money. In 2008, the prop firm Tuco Trading was shut down by the SEC. In the legal proceedings that followed, the records of the accounts were made public. There were 206 active accounts when the firm was shut down. Out of those, only 33 were profitable. 84% of them were not making money. What's more, only 7 accounts were worth more than $50,000, meaning only 3% of the traders were demonstrating any serious success. So these sources put the failure rate somewhere above the 80 to 90% range. But those numbers include established experienced traders. If we look at new traders, then the failure rate would easily be much higher, perhaps a lot higher than 90%. And what do I think? I think it's easy to make money trading stocks, but it's even easier to lose money. There are plenty of examples of traders who make money for a while, then go on to lose it all. After almost 13 years of experience, I still find that consistent, profitable trading is extremely challenging. The only thing that convinces me that I'm any good at this is the balance in my trading account. Only 1 out of 10 people that attempt to trade will go on to make money and stay in the business. Obviously, we all want to belong to that minority, the 10% of traders who succeed. In this short time we have together today, I want to talk to you about joining that 10% club.
Please call the meeting to order.
I don't know about you, but I'm not interested in just mediocre success. My goal is to be a great trader. I want to be among the best of those 10%. I'm going to share with you my story of how I got started, and I'll offer some advice and insights on how to improve, and I'll tell you what I think you need to do to succeed. Despite the challenges facing us, it can be done. Let's start at the beginning. My first experience with the stock market was back in 1988. When I was in the 8th grade, I had the opportunity to be in a stock market contest put on by the school. We had teams of 3 players each, and each team was given $100,000 to play with. There were over 100 teams competing among all the schools in the region. Unfortunately, my teammates, being young adolescent boys that they were, didn't have much interest in winning. No. They were way too excited by the opportunity to buy Playboy, symbol PLA. Honestly, I didn't care much for their juvenile strategy. I wanted to play to win. Needless to say, Playboy didn't do much during the 10-week contest, and we ended up with a modest loss. But the next year, I grew wiser. I recruited 2 teammates who were completely indifferent and convinced them to let me manage the entire $100,000. For the first 6 weeks, I scoured and studied the financial pages of the local newspaper looking for patterns, something that could give me an edge besides just picking companies that sounded cool. I tried lots of different ideas, usually trading low-priced stocks in an attempt to capture a big move. And at first, nothing worked. 6 weeks into the competition, I was dead last out of over 100 teams. 100 grand reduced to $65,000. LX21 was on the verge of his first ever account blow-up. But then I noticed something. Oak Industries, symbol OAK, every few days would alternate between closing at $1 and 1 1/8. My first stock trading system was born. Buy it at $1, short it at 1 1/8. After it worked a few times, much to my shock and surprise, it closed at 1 1/4, a 25% gain. Unfortunately, time ran out on me, with my account now at $106,000, a gain of over 60% in 4 weeks. I finished first in my school, but fell short of being the regional winner by just $1,000 or $2,000. The real victory, though, was the seed it planted in me, the idea of making money just by playing with stocks. Fast forward 10 years, happily married and living in New Jersey. I worked for a small family-run company. We installed sound systems, computer networking, and all sorts of electronics. One job we had was at a real nice house on the bay. It was a huge job. Speakers, security cameras, home automation, the works. This guy was loaded, and he wanted it all. Marco Fiore, a bachelor in his early 30s, made his fortune day trading. At 6 foot plus and over 250 pounds, this guy looked and acted like someone right out of The Sopranos. He was the perfect stereotype for a mid-level Italian mafioso. I would have loved to ask him to teach me how to trade, but the problem was he had an unimaginably bad temper. Once, we were scheduled to work at his house finishing up a home automation system that had very complicated voice recognition software. Marco took the day off so that he and my boss Glenn could spend the whole day programming the system. Glenn was not the most reliable type. He couldn't make it that day and forgot to tell Marco. But my coworker and I still went. Big mistake. When we arrived without Glenn, Marco flipped. He's not here? He canceled? I took the day off for that. You guys have any idea how much money he just cost me? I make $10,000 a day. You guys cost me $10,000. Hope you're awake. $10,000 a day. That stuck with me. I would have been happy to make $1,000 a week, let alone $10,000 a day. But now, I knew what I wanted to be when I grew up. A day trader. And that picture I found of Marco, I found it in this book, Born to Steal, When the Mafia Hit Wall Street. I would only find out years later that Marco was not a day trader. He was one of the head honchos of a big boiler room operation run by the mob. 10 grand a day. Yep, those guys are good. Don't jump to conclusions. Running a boiler room still looks good on a resume. Here's his updated bio. An accomplished businessman, Mr. Fiore has a strong background in mergers and acquisitions, strategic planning, operations, and now Marco Fiore is Mark Fiore, the movie producer, making movies such as Mob Street, a film about the mafia running Wall Street, and other mafia flicks. Here he is with John Travolta and John Gotti Jr. promoting the upcoming Gotti in the Shadow of My Father. Don't underestimate stock promoters. It would take me another couple years till I got started. I moved on and started a small business building wooden swing sets. It was pretty good money, and I enjoyed the work. But being self-employed, no one was withholding my income taxes. By November of my first year in business, I had over $25,000 in the bank, most of it earmarked for the IRS. It wasn't due until the following April. 5 months to go, and I had $25,000 sitting in a checking account. I wanted to do something with it. This was 1998. Online trading was taking off. Day traders were making $10,000 a day. So I decided to start researching stocks, see if I could find something to do with my 25 grand. Wasn't planning to do anything until I found a really good idea. This wasn't my money. I could not afford to lose it. So stock research practically became a full-time job. I looked everywhere. I looked at websites, I would spend hours at the local borders flipping through every trading book. I would try services, but nothing was worthwhile. I had to learn everything the old-fashioned way, figure it out myself. For weeks on end, I would read and research whenever I could. But finally, late one night, I had my eureka moment. I found a chart pattern to short internet stocks. Now I was ready to go. In January of 1999, I took some time away from building swing sets. Armed with my short trade account, I put my 25 grand of IRS money to work and started trading. It was always my intent to return to building swing sets, but within a few weeks, I was making more money trading. And within a few months, I was making far more money trading. I never actually decided to become a trader. I simply never stopped trading. Over the years, I've had far too many near-death experiences with blowups, and my first one happened after only 6 months of trading. Here I was on a roll. I was making a prof on every single short. I could do no wrong. In July of 1999, I saw a stock, Metricom, symbol MCOM, start making some relatively large moves. Once it was up almost 200% on the week, I placed a few trades, nothing too big. And then it kept up, so I shorted some more. And it kept going, so I shorted some more. Before I knew it, I had too many shares of a stock that would not stop going up. Only a few weeks before, the stock was trading at $5. And then, on July 9th, 1999, my 25th birthday, the stock broke through the $50 level and surged all the way to $55 a share. My account was down by 50% on this one trade. I couldn't take it any longer. If the stock kept going, I would be broke. So I felt like there was no choice, and I covered. Just like that, at the top of a monster run, I covered my entire position, a loss of almost $50,000. An hour or two later, when I recovered my sanity, I took another look at that stock, and you know what? With fresh eyes, I could see that the right time to short it was now. But it was too late. None of my brokers had shares to short. And of course, Metricom crashed over the next few days. I was devastated. My confidence was shattered. Words cannot describe the trauma of going from invincible and on top of the world to screwing up so bad, to blowing more money on a single mistake than you ever made in a single year. With only 6 months of experience, it was natural to question whether any of this was actual skill. Was it just a hot run and now my time was up? I seriously considered quitting while I was still ahead. Confidence is not easily restored after a wreck of this magnitude. Go ask Baron Kimball. Fortunately, I didn't quit. I decided to persevere a little longer. Things were slow for a little while, then the market really started to heat up. The internet bubble went crazy beyond my wildest dreams. The NASDAQ index doubled in only 7 months. If you weren't trading back then, and there's simply nothing to compare it to. Every day there were stocks doubling and tripling. It was insane, and I was shorting into it like a madman. From July to the end of the year, my account grew from a low of $55,000 to over $650,000. Thank God I didn't quit. I've been trading ever since. There's a lot I've learned since my early days. I'm going to share some of that with you now. Let me start with this question. Who would make the best trader? An accountant, a broker, an economist, a mathematician, or Jim Cramer? Just kidding about Cramer. Or a poker player. There's no correct, what's your guess? Poker player. There's no correct answer, but I strongly believe that by far the poker player would make the best trader. Author of The Market Wizards, Jack Schwager, notes that it is interesting that so many of the traders I have interviewed are poker players. I learned more about option trading strategy by playing poker than I did in all my college economics courses combined. If you apply the same principles of poker strategy to trading, it increases your odds of winning significantly. Why is this? What could playing poker teach a trader? Several things. First of all, poker players pay attention to their opponents. They want to know who they're playing against. Who are the smart players? Who has deep pockets? Who likes to bluff? I find that in trading, it is really helpful to try to understand the other traders that are in your stocks. I pay attention to who else is in the trade, who is buying and who is selling. Just like in poker, you want to pay attention to your opponents. Second, good poker players have superb money management skills. In poker, you're out of the game if your count drops to 0. Good players are notorious for folding quickly. A good player knows when to bet big and when to quit. And traders should do the same. Perhaps even more important, poker players learn to think in terms of odds, probabilities. They do not predict the next card or what hand they're going to have. They observe and interpret, then bet based on the odds. When the odds are poor, they fold. When the odds are good, they bet. And when the odds are really good, they bet big. I found an immediate improvement in my trading the day I officially stopped trying to predict. I realized that all my profits were coming from reacting to what I saw, never from predicting what I thought would happen. Now I try to only think in terms of odds and probabilities. When the odds are in my favor, I bet. When the odds are strongly in my favor, I bet big. I do not predict the outcome. I merely look for good opportunities and bet accordingly. I used to work every day of every week of every month of the year. I barely ever took days off. To avoid burnout, a couple of years ago, I started taking summers off. When I'm off from trading, I'll still check in here and there just to keep an eye on things. Does anybody remember liquid metal back in 2010? That's a stock I surely would have traded if I wasn't off from trading. Any of you remember Sino Global Shipping this past summer? S-I-N-O? Sino Global Shipping. That's another stock I surely would have traded if I wasn't off from trading. When I took a look at both of those charts, I had no idea where I would have traded them. At first glance, I think I might have entered too early. And trying to figure out where I would have exited was just a wild guess. And this made me realize something. I can't trade part-time. I can't just check in with the markets. I need to be immersed in the markets, to be in sync with everything going on. When I'm immersed in the market, I become fluent in its language. I'm able to interpret it. When I'm away, it becomes a foreign language, and it doesn't make much sense. What does this mean? Why is immersion important to me? A chart pattern by itself is often not enough to determine when and where to place trades. I read chart patterns all the time, but without understanding the entire situation, it's much harder to figure out what to do. There are times when the exact same chart pattern could be a buy or a sell. So, when I read a stock chart, I want to take in all available information on the stock and then put the chart and the price action into context of everything I see. The first thing I do is identify, why is it up or why is it down? What's the catalyst behind the move? Is there any news out? Are there any rumors? Are any analysts following it? Did any of them change their recommendation or price target? I try to gauge the sentiment on the stock. I'll look at chat rooms, message boards, Twitter. I want to know who else is trading it. Are there a lot of day traders in the name? Are a lot of people shorting it? How about people with a big following? Is the media talking about it? How about bloggers or seeking alpha? Some stocks move in sympathy with others. If another company in the sector had major news, there's often carryover. Even fundamentals can come into play. Do they have a lot of cash or debt? What's the float? Are insiders buying or selling? And finally, the type of market we're in can have a huge influence on how stocks trade. Most information can quickly be filtered out as noise, but what's most important and what should be focused on changes each time. Once I identify the key elements behind the stock's move, then I can begin to understand the chart pattern. I could not imagine doing this if I were trading part-time or only checking in with the market. I used to trade a little more like that, and I would miss stuff all the time. I don't mean just missing opportunities. I would focus on the setup and miss pieces of the puzzle that could have greatly improved my entry or exit. Remember Metricom, the stock I told you about that got killed on my first year? In retrospect, I can tell you there were pieces of the story I missed. I could have avoided that loss. I might have actually made a profit on that stock if I was more in sync with everything going on. I have over 400 stocks on my watch list. Most of them I'm just watching. I have alerts on them just in case. But with so many stocks, I need a way to narrow them down to the ones I want to trade. I developed a basic rating system. Once a stock on my watch list becomes tradable, I move it to the top of the watch list and then assign it a rating from 1 to 4. A 1-star rating is the most common trade setup. They're not great, but they're tradable. If something merits a 3-star rating, then I definitely do not want to miss it. And 4-star trade setups are the best. Every once in a while, there's a trade setup that's even better than a 4-star rating. So I have to add one more level.
This is a top to, what we use on stage, but it's very, very special because if you can see, the numbers all go to 11. Look, right across the board. 11, 11,
and most of
11,
the
and then
amps go up to 10.
Exactly.
Does that mean it's louder? Is it any louder?
Well, it's 1 louder, isn't it? It's not 10. You see, most blokes, be playing at 10. You're on 10 here, all the way up, all the way up,
Yeah.
all the way up. You're on 10 on your guitar. Where can you go from there? Where?
I don't know.
Nowhere, exactly. What we do is if we need that extra push over the cliff, you know what we do?
Put it up to 11.
11, exactly. 1 louder.
Why don't you just make 10 louder and make 10 be the top number and make that a little louder?
These go to 11.
My 5-star rating is an 11 on the volume knob. They aren't the best, they're the best of the best. The 5-star rated trades are very rare. They are gifts from the market. When I first started trading, I figured why not trade all the setups? The lower rated setups would take up most of my time, energy, and buying power, but would add little to my bottom line. Over time, I began to realize that majority of my profits were coming from the 4- and 5-star trades, even though they were a small minority of my trades. And sometimes by trading the 1- or 2-star setups, I would completely miss a 4- or 5-star setup. The distraction of having so many trades would cause inferior entries and exits. I realized that the opportunity cost was so great that I could actually make more money by trading less. I want to trade only the best setups. Now, remember my boss, Glenn, the owner of the small company in New Jersey I told you about? He loved to make bets with friends. We had a thing going. When we had a disagreement, we'd occasionally settle it with a friendly $1 bet. I would win so often that I started to keep track. After a few months, I had won 19 out of 21 bets. And the next time we had a little disagreement, he wanted to settle it the usual way, with a $1 bet. And this time, I declined the offer. He looked at me with a mix of befuddlement and disappointment. What? Why won't you bet me? Because I only bet when I know I'm right. My track record had nothing to do with being smarter than him or better than him. It was because I was being very selective. You want to win at trading? Then only bet when you know you're right. The lesson here is don't trade just to keep busy. I have to constantly fight that urge, and I struggle with it just like everyone else. It's hard to stare at moving numbers all day long and not act. It's hard to watch people post trades in chat rooms all day long and not act. But just because everyone else is buying waffles doesn't mean it's a good idea.
The Fed is going to be lowering rates, so get your money out of T-bills and put it all into waffles. Tasty waffles with lots of syrup.
Waffles! Buy waffles!
Actually, come to think of it, I think there's a name for people that trade that way.
A jackal! Jackal! It's a jackal! It looks like a jackal! 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 It's a jackal! Jackal!
Time!
It wasn't right the first time you said it. Why the hell would it be right the next 10 times? God!
Trading to keep busy costs you money. You need to be patient. Patient to wait for the best opportunities. Patient to wait for the best entries. and patient when you're in a trade to let it work. Think of it this way. As traders, our job is to be patient. Most of our time should be spent watching and waiting. Let me tell you, I have insecurities. In my heart, I never feel like I'm going to make any more money trading. Even if I'm up by $500,000 by June, then in my heart, that's all I expect to make for the whole year. And you know how much I expect to make next year? Not the rational answer. I mean the gut feeling. 0. You know where this comes from? No matter how hard I work, no matter how hard I try, I cannot create trading opportunities. I want to be ready for when they appear, but I will not find them if they don't exist. And anytime I do find a great trade, I'm in utter disbelief that people could be so foolish to let me find a stock for such an incredible price. I'm always surprised to find the great trades, and I never expect to find one again. It's all about waiting for the good opportunities, the best of the best trades. The legendary Jim Rogers said it best. I just wait until there's money lying in the corner, and all I have to do is go over there and pick it up. Dynamic trade management. Exits based on the best chance of success going forward. I spent years designing and testing computerized trading systems. I never found a single trading system whose performance was improved by the use of price stops. Not one. You ever notice how many times stops get hit and then the stock goes on exactly as expected? There's so much noise in the markets that stops get hit before the trade actually fails. I do not like stops. To me, they're just arbitrary price points. So how do I decide if I should exit a trade? Well, what's the reason I got in the trade? What's the thesis for it? I exit when the thesis is no longer valid. What about profit targets? If everything goes perfect, I can expect a stock to hit a certain price. That's the best case scenario. But I also said I want to react, not predict. If I hold out for that best case scenario price, then I'm predicting. Instead, I want to read and reinterpret the trade each step of the way. Once again, is the thesis still intact? Does everything I see continue to support the original idea? Sometimes the thesis actually improves, and I'll hold on to the trade longer than I originally expected. But once the thesis breaks down, I'll exit. It's the same method for both stops and profit targets. I talked to you about being immersed in the market. The market is in constant motion. New information is always being revealed. Nothing is ever the same from moment to moment. When something changes, I want to adapt to it. For both stops and profit targets, I'm reevaluating the trade moment by moment. It's dynamic trade management. But it's not always easy. Perhaps new information has come out and the stock is moving. I have a mounting loss. This may be a good opportunity to add to the trade or maybe a sign to get out now. I have to quickly decide what to do. I want to make a decision based on what's the highest probability of success going forward, not based on where I bought it or how much money I'm losing. So if I'm having a lot of trouble figuring out the best thing to do, I use this technique. I'll clear my mind as much as possible. I imagine that this is the very first time I've ever seen the stock, the chart, and everything that goes with it. It's as if I don't have an open gain or loss. I don't have a position. I've never traded the stock before. Then I ask myself, if I didn't currently have a position, what would I do right here? If I never traded this before, would I buy it or short it now? I'm looking for the quick answer from the gut. I'm trying to avoid any rationalizing. A lot of times, it's the rationalizing that got me into the trouble spot in the first place. And this may sound weird, but sometimes, if I'm really confused, it's actually best to ask and answer the question out loud. By speaking and hearing our thoughts, we use different parts of the brain. Sometimes you can get a surprising answer when you ask and answer the question out loud. If I'm short and the answer is I'd buy here, I exit immediately. Sometimes the answer is I'd be shorting here, in which case I may end up adding to it. And often the answer is I'd do nothing, in which case I reduce my position size and continue to watch for more clues. Unfortunately, I don't come close to my full potential. I screw up all the time. I end up sabotaging myself. I overthink trades. I chicken out of good trades. I take profits way too early. I hold on to losses like a dumbass. And I'll hold on to profitable trades too long. Just sit there as the trade reverses and watch my profits evaporate. I should know better. In any given week, I probably only make 50 to 75% of what I could if I executed my strategy perfectly. Even when I'm on top of things, I probably realize less than 90% of what I could make. But I don't believe that anyone realizes 100% of their potential. If two traders trade the same system, they will often have drastically different results. This means that a large part of our profits are not determined by the strategy, but by the trader himself. As a trader, I want to perform as close as I can to my full potential. Why is it difficult to act in ways that maximize our profits? The problem is that traders are human. The human mind is programmed by evolution. It is programmed to enhance the organism's chance of survival. It is not programmed to be a good trader. What's good for survival is often the opposite of what's good for trading. Few of us have access to a trading coach, so each one of us is our own coach. That means we are the ones who must master our emotions and our thinking. To become the best trader possible, you must become a master of your own mind. Mastering the self as a trader is never complete. It is a journey with many setbacks. But the rewards are plenty. I start with learning as much as I can. I study books on trading psychology. Next, I want to be an objective observer of myself. I observe myself when I trade, and I want to be brutally honest with what I see. The bottom line, the P&L, doesn't care about my ego. To find faults, I need to be humble enough to admit them. That's not always easy. Let's talk about the different elements of the self you want to be aware of and master. It's the biases I'm so concerned about when I describe the clear your mind technique. See, our brains are always trying to convince us we're right through many built-in biases. Here are some of the major ones. Blind spot bias. If you don't think you have this bias, then you do. It's the tendency to see biases in other people around you, but to be blind to the influence of the bias in yourself. Improving as a trader means actively looking for the influences of your biases, not denying them. This one is probably the biggest one for traders, confirmation bias. Confirmation bias is the tendency to look for and find evidence to support your already existing beliefs and to ignore or reinterpret anything that contradicts your beliefs. Confirmation bias is real easy to see in politics. Our party is always perfect. It does things for the right reasons. The opposing party is always incompetent. It has evil motives. And of course we believe these things because we look for and cherry pick the things that prove it. In trading, this is very dangerous. If you're long a stock, the tendency is to look for all the reasons why you're right, why it's such a great trade. The market doesn't care how good your arguments are, and neither should you. The only thing you should care about is making money. So you should be playing devil's advocate. Actively explore reasons why you're wrong. Where else does confirmation bias come into play? I see it all the time when people try to pick a bottom or a top on a stock. And I admit I do it too. I remember back in September when the stock for Netflix dropped by almost $100 in a week. Each day as it dropped, people were trying to pick the bottom. And each day, they readily found plenty of reasons why the bottom was in. But each time they bought it, it just kept going lower. Confirmation bias is also dangerous when using technical analysis. If you look at enough indicators, you can almost always find something that confirms what you're looking for. In fact, you can often just change the time frame on an indicator to convert a sell signal into a buy. Sunk cost bias, the tendency to believe in something because of the cost sunk into that belief. Once we start to lose money on a trade, we are very reluctant to take a loss and move on. This is natural, we all do it, but it's definitely not very beneficial for trading. The odds of success going forward have nothing to do with how much money you're losing. Trust me, I've had occasions where I was short a stock, sitting on a large loss, and if it weren't for having a loss, I might have been buying it and going long. My bias gets in the way. And hindsight bias. This one drives me crazy. It's the tendency to view past events as predictable. Hindsight bias will convince you that trading is easier than it is. I kick myself over and over for leaving money on the table and missing such obvious good trades. The knee-jerk response is to get the next one. Unfortunately, the result is overtrading and trading too aggressively. Now, by far, the aspect of trading psychology that gets the most attention are the emotional extremes of fear and greed. There's plenty written about it. We should all be very familiar with it. I just want to make 2 points. It is not fear or greed that's the problem. It's the impact they have on you that's the problem. I've had many trades where, despite skyrocketing fear due to a mounting loss, I was still able to execute my trade according to my plan. You don't have to suppress fear and greed, just not give in to it. The second thing I want to point out, emotions are part of the human experience. I've heard it said that you should trade without emotion. Show me someone without emotion, and I'll show you someone without passion. Emotion and passion are the driving forces that motivate us to succeed. Imagine Aaron Rodgers, the star quarterback of the Green Bay Packers in the Super Bowl last year. Do you think he wasn't full of emotion heading into that game? Do you think he just casually walked into the first play of the game with a ho-hum attitude? Of course not. The trait of great champions is not that they don't have emotions, but that they're able to channel their emotions in positive ways. The extreme emotions become a positive energy that drives them to have peak performances when it counts most. And now the one that to me is much bigger than fear or greed, confidence. Overconfidence, to be specific. I pay more attention to my confidence levels than anything else. So many of my biggest losses came on the heels of an increase in confidence that now I do everything I can to minimize my confidence. Remember the Metricom trade where I blew half my account? I was way too confident. What happens when champion athletes get too confident? Mike Tyson was one of the most feared fighters in boxing history. The undefeated, undisputed heavyweight champion of the world. He knocked out almost everyone he met, and often in the first round. In 1990, he went on to fight Buster Douglas, a relative nobody. Tyson was a 42-1 favorite. This fight was supposed to be a warm-up bout for his next opponent, Evander Holyfield. Tyson did not take the fight seriously. Overconfident, he didn't train or prepare the way he usually did. And Tyson didn't just lose in one of the biggest upsets in sporting history, he got knocked out. Show me an overconfident athlete, and I'll show you someone who is on the verge of an upset. Just like a champion boxer, I'm susceptible to getting knocked out when I get too confident. If my confidence ever balloons into hubris, watch out. Every time it's ever happened, I had my head handed to me on a platter. When I'm overconfident, I'm not on guard. I put too much money on trades, I take trades I shouldn't, and I don't see the warning signs of when I'm wrong. In order to suppress my confidence, I try not to celebrate my big wins. The big wins aren't because I'm so awesome or I'm a genius. They're gifts from the market. I want to have a constant fear that my next big loss could be right around the corner. I bet you guys would be surprised to see how little confidence I have. So how can I do it without confidence? It's conviction. There's a subtle yet profound difference between confidence and conviction. When I'm in the zone, I have a strong conviction to take the appropriate action, to follow my plan, even when I have almost zero confidence. It's conviction I want, not confidence. I want to break things up a little. The stock market is a big auction. I thought it'd be fun if we could play a little auction game. I want to raise money for charity, so we're going to use real money. Las Vegas was hit harder by the recession than any other major city in America. let's give back to the community we're in. We'll donate the proceeds of this game to 3 Square, a local charity that fights hunger and poverty in the area. I need 2 volunteers to play. The way the game works is I auction off a $100 bill. The winner gets to keep the $100 bill, but both players will donate their bid to 3 Square. I need 2 volunteers. Anyone interested in playing? Where's Tim? Come on. You sure, Reaper? Nah. Come on up. I thought so. What's your name?
Rick.
Rick. Good to meet you. Greg.
Nice to meet you.
Thank you for volunteering. Thanks, Tim. Appreciate your enthusiasm.
I'm gonna puke on you.
Come on now, this is for charity. Let's do this. Come on.
What do you want me to do?
$100. All you gotta do is bid for it.
This guy?
You're just bidding for it. Your bid goes to charity. If you win, you get the $100.
Okay.
Or you wait. Winner gets a cup of coffee.
Yeah.
All right. Want to start?
We're just gonna keep bidding.
Bid $10.
I've seen this before.
Oh, get down.
I'm sorry. I'll bid. I can't win, but I'll bid 20.
All right. 25.
25.
Can we just
30?
wrestle? I can take this guy.
You know I have a black belt, right?
You're a black belt?
Yeah.
Are you fucking serious?
Yeah.
Never mind my game, just do it.
Drunken monkey. Sorry, 30.
All right, 35?
Absolutely. 35.
Do we have 40?
50.
We got 50. 55?
I'll go 60.
We got 60.
700.
705?
No.
$700 to charity?
$700 to charity.
You got it. Congratulations.
Thank you. Is this 501c3?
Yes.
Cool.
Yep. And
Charity.
60?
60, yeah.
Thank you very much.
Thanks.
Appreciate it. Go get a coffee. Oh, it's for poverty and helping the hungry.
Do I get to meet them?
They're right outside in the hallway. All right, let's talk about the blow up. What are the ways that traders blow up their accounts?
What?
Excuse me, ma'am. Don't you think you've gambled enough?
No.
Okay. We're required by law to ask every 75 hours. Get another free drink.
I hope Marge Simpson doesn't remind you of yourself at the trading computer. If a trader is losing over and over, but they can't seem to stop trading, then they are probably addicted to the action. The only way they stop trading is to bleed the account to death. Second, trading too big. Often new traders don't have much choice if they start with a small account. Making back losses. When traders take large losses, their natural impulse is to recoup it quickly. They find themselves increasing their trade size and repetitively making large bets. They compound the original loss until there's not much left. And last, poor money management. Money management is what keeps you in the game when things aren't going so well. If you trade long enough, you're bound to have some bad luck. Some stretches of trading where you do everything right, but you still have a string of losses. Without proper money management, a trader's account may not survive such a slump. Hopefully, you will graduate from making these errors as you get better and build up a substantial account. It's understandable that a new trader could blow up an account. They're still learning. But when you read the market wizards books, you find that even some of the great traders experience blowups. Victor Niederhofer, a legend in his own right, blew up twice. Long-term capital management was run by some of the most brilliant minds in finance, including 2 Nobel Prize winners. Their fund blew up in spectacular fashion. So how could a seasoned trader, someone who's been making money, sometimes for years, suddenly blow up? Surely he should know better than to make the typical beginner mistakes. It doesn't start off with a wild bet. In 2005, I had my best year ever. I made over $450,000 on a single trade. Remember that one, Tim? I had Thank you. I had a prime broker with Goldman Sachs. They were starting to cultivate a niche as a specialty broker for small hedge funds. And they took notice of my performance and proposed putting together a fund for me to manage. And they said they could even get the initial investors lined up. They thought I was that good, and I believed it. You would think I learned my lesson from my near blow-up with Metricom in my first year. Trading with a big ego is dangerous. As soon as you start to think you're smarter than the market, you're asking for it. You have to respect the market. It is much bigger than you. Well, I wanted to follow up 2005 with another great year. I started to dream big. I wanted to take it to the next level. Self-improvement books talk at length about the importance of setting goals. So I set ambitious goals for 2006. I set a goal to make $3 million that year. Earlier I said, react, don't predict. Wait for opportunities. These are important lessons.
You hit the 3 million?
I'm getting to that. Thank you. As soon as you start to try to make things happen, you start forcing trades. Stocks will go up or down on their own time. You can't make money just because you want to. Well, 2006 started off okay. I was actually doing pretty well, but I was unsatisfied with my typical returns. And along came a penny stock, Fomex Industries, symbol FMXIQ. It shot up from less than 25 cents a share to over $1 in just a few days. It looked like a great opportunity for a quick profit, so I shorted some. At first, it's just a regular old trade, completely ordinary. There's no warning sign. The trader doesn't see what's coming. He's not planning to bet the farm on a single trade. In his mind, he's just doing what he's always done. And so it was for me. I had no idea what was coming. Question: how much money can you lose when you buy a stock? All of it, 100%. How much money can you lose when you short a stock? Right. In theory, the losses are infinite. The potential losses are infinite. When you short, your risk exposure can be deceptively large. Your position size might not actually start off too big, but as the stock goes up, it mushrooms. Whenever you use leverage or sell short, your potential losses are always larger than your account. So, on Fomex, FMXIQ went to $2 a share. Now I was getting excited. This was a good opportunity, getting better. I was carrying a loss, but I was going to make up for it by shorting more at this price. And here's where the confidence becomes so dangerous. Overconfidence got me into the trade early. Overconfidence is how I ended up trading big. And now, overconfidence led to denial. This can't happen to a good trader. No, I'm too smart to make such a bad trade. But before long, I was wiring money in from all my accounts to avoid a margin call. From below 25 cents a share, it surged past $4 a share. I now had 551,500 shares short. I became such a big risk to my firm that my broker threatened to close out some of my position. And of course, it could only get worse. Guess who disclosed a 4.8 million share position in the stock? None other than Goldman Sachs, the same broker who was loaning me all those shares to short. The head of the brokerage firm called me up to inform me, we're going to have to close out part of your position. It's not going to be good when news of this hits the street. Well, brokers are not good traders. Markets price in news and often sell on the news. And of course, he bought me in right near the top. The stock came close to $5 a share at the peak. At one point, I was staring at a loss of $1.5 million. When's the best time to plan your exit? When will you get out? The best time to think about when you're going to exit a trade is before you get in. The next best time is right after you enter the trade. When hedge funds blow up, they often explain it away as due to unusual circumstances or extreme market conditions, a black swan. As if they did everything right and the failure was due to something that only God could have predicted. Nonsense. It is never an excuse to say you didn't see it coming. A trader must assume full responsibility for anything that can happen. What will you do if this trade, no matter how unlikely, becomes a black swan, a once-in-a-lifetime event? Have you ever heard the phrase, it can't go any lower? It can't go any higher? Yes, it can. It can do whatever it wants. Well, slowly over the next few weeks, the stock did come down a bit. It took a while until I closed out the entire position. By the time it was all over, I'd lost $771,000. My motto, thanks in part to this experience, is expect the unexpected. These days, when I short a stock, I try to think of the absolute worst case scenario possible. What if the stock gets there? What will I do? Will I survive? There's no way to describe the psychological trauma of a loss of this magnitude. I almost quit trading. It took me years to recover. In fact, I never quite regained all my confidence. To this day, there's nothing I fear more than the blow-up. To anybody who wants to trade as a contrarian, I want to warn you to be very careful. And by the way, to this day, I never, ever set monetary goals. Many great traders have had similar catastrophic experiences, and quite a few of them were much worse than mine. An experience like this could be the sad conclusion to your stint as a trader. But the great traders learn from a disaster. Like a phoenix, they rise up from the ashes, and they become even greater than they were before. The market is a big competition. We're all competing with each other for a finite amount of money. Often one person's profit is someone else's loss. In order to make it, you need to have a higher standard than the masses. Average does not cut it. Even above average will not be enough. Being profitable demands a high level of accountability. Almost all of us here are self-employed. We have no boss. There's no one to tell us what to do, no one to motivate us, no one to guide us. Without someone to keep us in line, we're on our own. So to find a way to rise up to the challenge, to put myself on a path of success, I like to think of it like this. A professional is someone who makes a living practicing his craft. An amateur is someone who does it for fun, as a hobby. If I want to be successful, if I want to consistently make money as a trader, then I have no choice but to think and act like a professional. This is the essence of my personal philosophy. Here's what it means to me. Train like a professional. Recall that 90% of traders fail. Now consider how easy it is to become a trader. Anyone with a few $1,000s to their name can open an account and call themselves a trader. Could you imagine any other business where this is the case? Sure, I'll buy a guitar and call myself a musician. Or what if I put QuickBooks in my computer? Does that make me an accountant? This is absurd, but that's what some people are doing when they open up an account and just jump in. To that I say, of course, most people will fail if it's that easy to get started. Consider what Van Tharp said in the Market Wizards book. The top traders that I've worked with began their careers with an extensive study of the markets. I began my career with 2 months of research before I placed my first trade. And I continued to be a research maniac after that. Earlier I said it's conviction that you want. And where does conviction come from? Both conviction and intuition are the result of many hours of study and practice. Conviction doesn't come from just reading a book or following a service. After 13 years, I still research. I read trading books and I attend conferences. I'm still in training. Take your training as seriously and train like a pro. Number 2, act like a professional. There is a razor-thin margin between making and losing money on a trade. I took a look at my last 3 years of trading, and I found that my average profit was 1.4% per trade. On a $5 stock, that's only 7 pennies. A mistimed entry on a $5 stock could easily be more than 7 cents. A sloppy exit could easily cost me 7 cents. Even on a $20 stock, 1.4% is only 28 cents. I can't tell you how many times I went to sell my shares on a $20 stock only to have the bottom drop out on me. I'd press the send button, and 3 seconds later, with a tiny partial fill, the stock is down 30 cents, killing practically all my profit. The point is that the little things can make a big difference. So professionals pay attention to details. They focus on fundamentals. They look for every little edge they can find. I have spent countless hours trying to find ways to make trading more efficient, looking for ways to shave seconds off the time it takes to place orders and find information. I wrote custom programs for stock alerts, so I rarely miss a stock that's moving. I made my own order placement program just to take a few seconds off how long it takes to put in an order. I go way over the top, but so do professionals. Lance Armstrong used to tweak his bike, paying attention to every little millimeter of adjustment just to find the slightest improvement. He would spend weeks in the wind tunnel during the off-season just to shave a few seconds off of his time trials. Pros realize that every little bit adds up. How does a pro act in daily life? He wants to perform his best every time. He pays attention to both his mental and physical health. That means sleeping right, eating right, and exercising. Last, work like a pro. When I'm trading, I want to be completely focused on trading. I'm up at 4 a.m. Pacific time, and I work past the market close at 1. I keep breaks short. I don't even take breaks for meals. I'll eat at my computer. I try to avoid all distractions. It means no personal phone calls, no web surfing, no emails. I take this seriously. So many times, I took a loss or missed a profit for some dumb little reason. Just missing one little piece of information or a quick opportunity to grab a slightly better price. Every little bit adds up. I've always been haunted by the impression that some traders don't have to work hard at this. They brag about their success and make it sound easy. And it really bothered me for the longest time. Why do I have to work my ass off? Why does it always seem like I have to put in so much effort compared to everyone else? Over time, I found out that the traders who really succeed all work very hard. Scott Herman, the famous super secret broker, knows many very successful traders. He once remarked to me that of all the really profitable traders he knows, every single one of them works really hard. Many of the market wizards make it a point to mention the hard work they put in. The irony is that so many people are drawn to the markets because it seems like an easy way to make a lot of money. Yet those who excel tend to be extraordinarily hard workers, almost to a fault. Here are a couple more excerpts I want to share with you. How much vacation time do you take a year? I don't take vacations during the trading days. I haven't missed a day in the market in over 10 years. Even when you're sick? Even when I'm sick. I've traded through pneumonia. I've traded with a temperature of 105 degrees. He then goes on to describe his daily routine of 14-hour days and even working on Sundays. Don't you ever feel the need to take a break? My desire to be the best trader is greater than my desire to take a break. I don't like to get out of the swing. Marty Schwartz was one of the greatest traders of all time. In his autobiography, he too talks of working 14-hour days. When Jack Schwager asked him about his trading rules, Schwartz made it a point to mention that the last line on his rules simply says, work, work, and more work. These guys make me look lazy. Even the best, the legends of the industry, work hard. But working hard is not the same thing when you enjoy what you're doing. Putting in the long hours doesn't bother you when you're having fun. If you're living your dream, then making a few sacrifices really doesn't matter. If you knew how much work went into it, you wouldn't call it genius. I couldn't agree more. Only 1 out of 10 new traders make it. This does not mean that you have only a 10% chance of success. No. If you follow the path of what the 90% do, then your chance of failure is 100%. Follow the path of the 10%, then your chance of success is 100%. Do not leave your success up to fate. If you do the right things, you will succeed. It's up to you. Thank you.
My name is Tim Sykes, and I teach people to trade stocks. I am a self-made multimillionaire. So this is the ideal trade that I'm going to talk about. I want you guys to understand every single aspect of this trade.